stop looking at the spot price of $91. That number is a lie. Right now, as you watch this video, the price of silver in Shanghai, China has already exploded past $114. $114 an ounce. That is an $11 to $12 premium over the COMEX price in the United States. In percentage terms, that is a massive arbitrage gap. But if you think that spread is shocking, what is happening inside the United States is even worse. The system has effectively seized up. We have received official confirmation that the United States Mint, the sovereign producer of the American Silver Eagle, has ceased operations on silver sales. They have shut the doors. Their official statement claims they need to evaluate pricing adjustments. Let me translate that from bureaucratic speak into plain English. It means the price of silver is rising so rapidly, so violently, that the US government cannot update their website fast enough to stay profitable. They are literally terrified of selling dollars for dimes. They realized that their fixed pricing models were being arbitraged by the market, and rather than losing money on every ounce sold, they simply pulled the plug, and they aren't the only ones. Costco, the retail giant, is now rationing bars like we are in a wartime economy. They have instituted a hard limit, 1 transaction per membership with a maximum of 10 units per 24 hours. And even with those limits, the inventory is flashing sold out almost immediately. We are watching a commercial signal failure. The West is trying to suppress the price to keep the illusion of currency stability, while the East is draining the vaults at any price necessary. Even $114. And in the middle of this chaos, the CME Group has dropped a nuclear option on margin requirements that changes the rules of the game forever. If you thought $91 was the story, you are missing the forest for the trees. The real story is that the physical market has decoupled from the digital price feed. This is not just a bull run. This is a paradigm shift. While the physical metal is disappearing from the US Mint and Costco, the paper markets are launching a desperate counterattack. Faced with this runaway train, the exchange authorities have made a historic, unprecedented change to the rules of engagement. We are calling it the eternal margin nuke. Traditionally, when you trade a futures contract for gold, silver, platinum, or palladium, the exchange sets a margin requirement, a fixed dollar amount. For example, to hold 5,000 ounces of silver, you might need to put up $32,000. It was a manual, deliberate process. That system is gone. Earlier this week, the CME Group announced they are switching from a fixed dollar margin to a percentage of notional value. They are effectively pegging the margin requirement to roughly 9% of the total contract value. Why is this huge? Because it automates the pain for the bulls. Let's break down the math. A standard silver contract is 5,000 ounces at $91 an ounce. That contract is worth $455,000. $455,000. Under the new rule, you need 9% of that in cash. Roughly $41,000. But here is the trap. As the price of silver goes up, the value of the contract goes up. Therefore, the 9% margin requirement goes up automatically if silver hits $100. The contract is worth $500,000, and your margin requirement jumps instantly. If it hits 150, it jumps again. This acts as an automatic braking system on the price. Every time silver rallies, it becomes more expensive to hold the position. It forces leverage out of the system. It creates a scenario where traders are constantly hit with margin calls simply because their asset is performing well. Some might argue this is just to streamline operations. But if you look at the timing, right as silver goes parabolic, right as the physical shortage hits, it looks like a desperate suppression tactic. It looks like the COMEX saying, we cannot afford to let this market run, so we are going to make it prohibitively expensive to participate. It is a Hail Mary attempt to save the short sellers. But here's the flaw in their logic. This only affects the paper speculators. It does not stop China from buying physical bars. It does not stop the US Mint from running out of coins. All this does is widen the disconnect between the fake paper price and the real physical price. Let's circle back to the implication of the US Mint shutting down, because it is critical to understand the economic gravity of this. This is exactly what happens during a hyperinflationary event or a currency collapse. You walk into a store and there are no goods on the shelves, not because the goods don't exist, but because the store owner doesn't know what to charge you. If he sells you a loaf of bread for $5 today, but it costs him $10 to replace it tomorrow, he goes out of business. The U.S. Mint is currently facing that exact dilemma. They are paralyzed by the velocity of the currency debasement relative to silver. This is not a private dealer. This is the sovereign mint. When the government stops selling its own money, silver eagles, and when the biggest retailer in America, Costco, has to ration a commodity, price discovery on the screen becomes irrelevant. The price of silver isn't $91 if you can't buy it for $91. The real price is unobtainium. We are seeing the physical market decouple from the digital price feed. The dealers are backed up, shipping times are delayed, and the banners on every bullion website are asking for patience. This is what a supply squeeze looks like in real time. While the West struggles to price silver and manage margin calls, the East has already moved on. This East-West divide is a geopolitical economic war. In a functioning, efficient global market, an arbitrage gap of this size, $91 vs $114, shouldn't happen. Traders would buy every ounce in New York, fly it to Shanghai, sell it, and pocket the risk-free profit. That process should bring the prices back together, but the spread remains. Why? Because the metal isn't moving fast enough. Or, more frighteningly, because the metal available in the West is paper silver derivative contracts that cannot be easily converted into the physical bars needed to satisfy the Chinese appetite. China is bidding for physical delivery. They are draining the global supply. They don't care about the COMEX closing price, they care about possession. We are seeing a massive flow of physical wealth from west to east. The West, specifically the US and London, has suppressed the paper price of metals for years to make the dollar and the pound look stronger than they are. But China, knowing the geopolitical landscape is fracturing, is calling the bluff. They are saying, we will pay the real market price, and that price is over $100. This puts the COMEX in a death spiral. If they don't let the price rise to match Shanghai, their vaults will be emptied. If they do let the price rise, it exposes the inflation and currency weakness they have been trying to hide. We are watching the end of Western price dominance in precious metals. Markets do not move in a vacuum. This silver explosion is being fueled by a backdrop of extreme political instability in the United States and abroad. According to analysis from Bloomberg, this rally is being driven by a combination of the Trump trade and uncertainty surrounding the Federal Reserve. There is a growing narrative in the market regarding the independence of the Federal Reserve. We are hearing reports and rumors about potential criminal indictments against Fed Chair Jerome Powell, or at the very least, a significant push to remove him from power. The market hates uncertainty, but the precious metals market loves it. If the independence of the central bank is compromised, or if the market believes the next Fed chair will be a political appointee instructed to slash rates to zero, the dollar is effectively dead in the water. Lower rates and a politicized central bank are the ultimate rocket fuel for gold and silver. Investors are front-running this possibility. They are buying insurance against a regime change in monetary policy. Add to this the aggressive foreign policy moves we are seeing. The transcript highlights tensions involving the Trump administration's actions in Venezuela, capture of leadership, and renewed rhetoric regarding the acquisition of Greenland. These are not normal geopolitical maneuvers. They signal a return to a more aggressive, imperial style of resource acquisition, when the world sees the U.S. becoming unpredictable on the global stage. And when they see internal strife in Iran with violent protests threatening the regime, capital seeks safety. Safe haven assets are not just about inflation, they are about political risk. Right now, the political risk meter is in the red. Investors are looking at the U.S. debt, the political infighting, the geopolitical aggression, and they are saying, I don't want dollars. I want something with no counterparty risk. That something is gold and silver. Despite all of this, the $91 price, the shortages, the margin hikes, the $114 China price, the most incredible thing is that we haven't even seen the mania yet. If you look back at 1980, when the Hunt brothers cornered the market, or 2011, when silver nearly hit $50, those were periods of public hysteria. People were lining up around the block to sell their grandmother's silverware, or to buy coins. We aren't there yet. The retail public is just waking up. The buying we are seeing right now is institutional. It is sovereign. It is the smart money moving first. The average person on the street has no idea that silver is at $91. They have no idea the mint has shut down. This suggests that we are still in the early to middle innings of this move. When the mainstream media starts covering this 24/7, when your taxi driver gives you stock tips on silver miners, that is the top. We are far from that sentiment. Citigroup has upgraded their forecast to $100 silver and $5,000 gold in the next 3 months, but honestly, that feels conservative. If China is already paying 114, why would the price stop at 100 in the US? The ceiling has been blown off. The inflation-adjusted high from 1,980 is the only record left to beat, and given the rate of currency creation since then, silver could theoretically go much, much higher before it reaches true equilibrium. To wrap up this analysis, we have to look at the consequences. What happens next? We are likely going to see a period of extreme volatility. The COMEX margin changes will force some paper hands to fold, creating temporary dips. But those dips will likely be bought aggressively by the physical market. The floor has moved up. The US Mint will eventually reopen sales, but you can guarantee the prices will be significantly higher. They aren't going to sell silver at a loss. The premiums on physical metal will likely stay elevated or expand further. We are moving into a two-tier market. The paper price shown on CNBC, which might be managed and suppressed, and the street price, or Shanghai price, which is the actual cost to acquire metal. For the investor, the lesson is clear. Do not rely on the spot price to tell you the value of your asset. The spot price is becoming a fiction. The true value is determined by availability. If you cannot get it, the price is infinite. We are witnessing the slow-motion death of the fractional reserve bullion banking system. They sold more paper silver than exists in reality, and now the holders of those contracts, led by China, are standing at the cold delivery window asking for their bars. The window is closing, the mint is closed, Costco is limited. The question you need to ask yourself is not will silver go to $100? It is already there in the places that matter. The question is, what will you hold when the paper market finally admits it has nothing left to deliver? Gandalf the Grey, or rather, the meme version of him mentioned in the news, said it best. Hold on tight to your physical gold and silver, you fools. It's satire, but it's also the best financial advice of the decade. The ratio is dropping, the price is climbing, and the exits are being blocked by margin hikes and sales suspensions. We will continue to monitor this historic squeeze. As the East continues to bid up the price and the West struggles to maintain the illusion of control, one thing is certain. The silver market you knew yesterday is gone. Welcome to the era of true price discovery. Thank you for listening. This has been a special report on the silver crisis. Keep your eyes on the Shanghai spread and prepare for volatility. If you checked the U.S. Treasury market this morning, you weren't just looking at a red dashboard or a typical day of volatility. You were witnessing a historic turning point, the financial equivalent of a tectonic shift. Imagine a scenario where the world's most loyal financial partner, cornered by extreme economic necessity, is forced to prioritize its own survival over a decades-old alliance. What we saw on January 6, 2026, was a fundamental shift in global power, driven by the release of $1.2 trillion in U.S. debt into an already fragile liquidity environment. This isn't just about numbers on a screen, it's about the very plumbing of the global financial system being rerouted. The architect of this move isn't a geopolitical rival or a nation under sanctions. It is Japan, long considered the anchor of American financial stability in Asia. They have just triggered a restructuring of their U.S. debt portfolio on a scale that defies modern precedent. While mainstream outlets are quick to characterize this as a routine currency intervention, the reality is far more complex and significantly more consequential. This is a defensive mechanism for survival. It is a mandatory rebalancing that signals the end of an era of predictable bond markets. The smart money is already scouting for new safe harbors, leaving the general public to navigate a system that is changing in real time. Today, we conduct a forensic analysis of the data that few are willing to discuss. Let's reconstruct the timeline of this financial event. On January 6, 2026, at exactly 8:47 p.m. Eastern Standard Time, a technical update appeared on the Bank of Japan's BOJ website. There was no televised press conference, no grand fanfare, and no warning to the international markets. It was a single PDF document, released in Japanese first, with a delayed English translation. The core message: Japan was implementing decisive measures to stabilize the yen. In the coded, professional language of central banks, this was a signal for a massive seismic shift. To the uninitiated, it sounded like boring bureaucracy. To the high-frequency algorithms, it was a direct order to reposition. Within 90 minutes of that PDF release, the Treasury futures market in Chicago began to show signs of extreme stress. The algos detected a massive migration of capital before any human analyst on Wall Street could even finish their first cup of coffee. By midnight, the 10-year Treasury yield, the benchmark for global borrowing, had surged by an unprecedented 42 basis points in a single session. This is what insiders call a gamma flip, a phenomenon where a massive stakeholder stops maintaining their position and begins an aggressive liquidation, forcing market makers to sell even more to hedge their own risk. As of late 2025, Japan was the largest foreign creditor to the United States, holding over $1.1 trillion in Treasury securities. For over 40 years, the silent pact was simple. The United States provides military security in a consumer market, while Japan recycles its trade surplus into American debt to fund U.S. deficits. On January 6, that pact was adjusted. The gentleman's agreement that underpinned the post-1945 financial order has officially entered a period of fragmentation. The survival paradox of the yen-Japan is trapped in a survival paradox. Since 2022, the yen has devalued significantly, spiking to 161 per dollar in early 2026 for an island nation that imports almost all its energy and food. This is a slow-motion economic catastrophe. With a debt-to-GDP ratio of 264%, Japan cannot raise interest rates without triggering a domestic debt spiral. Their only remaining lever is to liquidate their massive stockpile of U.S. treasuries to buy back yen. They are choosing their own currency stability over the stability of the U.S. bond market. The liquidity cascade. This creates a liquidity event. U.S. treasuries are the primary collateral for the repo market, the multi-trillion-dollar overnight lending system that keeps global banks functioning. When Japan liquidates hundreds of billions in treasuries, they are effectively pulling the pipes out of the global financial plumbing. Algorithms detect this shortage of high-quality collateral and trigger automatic sell orders, creating a liquidity cascade. As prices drop, margin calls are triggered, forcing further selling and pricing in the potential for a systemic freeze. Japan versus China. The strategic contrast. While China has reduced its holdings strategically over 3 years, Japan's exit is an emergency response. It is unplanned and born of necessity. When your most loyal ally is forced to sell, it sends a terrifying signal to the world. It suggests that the U.S. Treasury may no longer be the risk-free asset that can be held indefinitely during a crisis. The Great Disconnect, paper V's, physical assets as faith in the debt-based system wavers, smart money is migrating toward assets with no counterparty risk. Currently, the gold-to-silver ratio is hovering at an unusual 88:1. There is a growing disconnect between the paper price on the exchanges and the physical reality in the vaults. Sophisticated investors are noticing that, while the digital price of silver is suppressed, physical premiums are reaching 30%. They are seeking unobtainium, physical assets that cannot be devalued by a central bank statement. The Federal Reserve is now facing what we call a checkmate scenario. They have two paths. The path of austerity, let yields rise to attract new buyers. But if the 10-year yield stays high, mortgage rates hit 10%, the housing market freezes, and corporate borrowing becomes unsustainable. The path of intervention. The Fed restarts quantitative easing, QE, printing new dollars to buy the debt Japan is dumping. This suppresses yields but destroys the dollar's purchasing power, signaling that the U.S. can only fund itself through inflation. We are witnessing the restructuring of the global economic order. Japan's pivot is merely the first domino. When the vassals of the empire begin to prioritize their own survival over the empire's currency, the endgame is no longer theoretical. The era of risk-free government debt is facing its greatest test. Discerning investors are pivoting toward assets that preserve value independently of central bank policy. What is your strategy? Do you rely on mainstream reassurances, or do you observe the actual movement of smart money? Verify the data. Watch the bid-to-cover ratios and the premiums for physical metals. These are the true indicators of the world we are entering. Let me know in the comments. How are these yield spikes affecting your local borrowing costs? Hit the subscribe button and turn on notifications. In a crisis this fast, being 24 hours late is the same as being wrong. Stay sharp, stay liquid, and always stay one step ahead. The system is choosing its path. Make sure you have chosen yours. While the general public remains focused on retail price charts and daily market noise, a fundamental shift in the global financial architecture has been finalized behind closed doors in Basel, Switzerland. The Bank for International Settlements, BIS, the central bank for central banks, has officially moved into the final implementation phase of the Basel III Endgame regulations. This is no longer a matter of debate or speculative rumor. It is a regulatory mandate that takes full effect when global markets open this Monday. The significance of this transition cannot be overstated. For more than 4 decades, the international banking system has operated under a paradigm where paper contracts, promises of gold and silver, were treated as equivalent to the physical metals themselves. This allowed major bullion banks to maintain massive leverage, effectively suppressing prices through unallocated accounts. As of Monday, that era of paper alchemy is being systematically dismantled. The implementation of the Net Stable Funding Ratio (NSFR) marks a Nixon moment for the 21st century. In 1971, the world moved away from metallic backing toward a pure fiat system. In 2026, through these new banking regulations, the system is being forced back toward tangible assets. This isn't happening because the banks want it. It is happening because the regulators have recognized that the current level of derivative leverage is an existential threat to global financial stability. Today, we will analyze the technical mechanics of this shift, the sudden liquidity vacuum in the precious metals markets, and why this regulatory reset is forcing the largest financial institutions in the world to abandon their short positions and secure physical inventory at any cost. The core of this transition lies in the reclassification of assets on bank balance sheets. To understand why Monday represents such a critical deadline, we must look at 2 specific components of the Basel III framework: Tier 1 asset classification and the Net Stable Funding Ratio (NSFR). The reclassification of gold and silver. Previously, gold was often treated as a Tier 3 asset, similar to a volatile stock. This meant that banks had to apply a significant haircut to its value when calculating their required capital reserves. Under the new mandate, gold is being elevated to a Tier 1 asset. This puts physical gold on the same level as cash and sovereign treasuries. It is now classified as a risk-free asset. This change provides a massive incentive for banks to hold physical metal to strengthen their balance sheets. The Net Stable Funding Ratio (NSFR) and the paper loophole. The most disruptive element of this rule change is the NSFR. This ratio requires banks to maintain a reliable profile of stable funding against their assets. For decades, the London Bullion Market Association (LBMA) and major U.S. banks used a loophole that allowed unallocated gold and silver, essentially paper claims, to be counted as high-quality assets. Starting Monday, the NSFR treats unallocated paper metal as a liability rather than an asset. Holding these paper contracts now carries an 85% stable funding requirement. In simple terms, it has become prohibitively expensive for a bank to hold a position in silver or gold that is not physically present in their vaults. The rules now penalize banks for holding naked short positions, bets that the price will fall without having the physical metal to back them up. The Monday deadline. This regulatory reset has forced a scramble in the overnight and interbank markets. Banks that have relied on fractional reserve bullion banking are now required to either purchase physical metal to back their positions or exit the paper market entirely by closing their short contracts. This is not driven by market sentiment or a sudden change in investor appetite. It is a matter of regulatory compliance. The banks are being forced to choose between physical acquisition or bankruptcy under the new capital standards. The liquidity vacuum and the end of price suppression. In the week leading up to this deadline, we observed a phenomenon described by many as a liquidity vacuum. Market makers, the institutions that usually provide the ask and bid prices, withdrew their sell orders. This wasn't a technical glitch. These institutions were recalibrating their algorithms to account for the fact that selling paper silver is no longer a viable business model under Basel III. For 40 years, institutions like JP Morgan and Citi could hold massive short positions to suppress prices because the cost of doing so was negligible. Now, the cost of carry has skyrocketed. When banks shift from being the primary sellers of paper to the primary buyers of physical, the price floor of the asset rises permanently. We are witnessing the end of fractional reserve gold and silver trading. The industrial conflict. The race for physical supply. This rule change creates a direct conflict between the banking sector and the industrial sector. Companies such as Tesla, Samsung, and Apple require silver for the production of electric vehicles, semiconductors, and solar panels. Historically, these companies benefited from the low prices maintained by the bank's paper manipulation. However, as banks are now forced to hoard physical silver to meet their Tier 1 capital requirements, the available inventory for industrial use is shrinking. We are seeing early signs of panic buying in the industrial sector. Manufacturers are attempting to lock in supplies before the banking sector absorbs the remaining global inventory. There is simply not enough physical silver produced annually to satisfy both the industrial demand of the Green Revolution and the new capital requirements of the global banking system. C. The geopolitical pivot. The Eastern model wins. It is significant that China and the Shanghai Gold Exchange have been compliant with these physical-only standards for months. The East has long emphasized the accumulation of physical metal over Western paper derivatives. By passing Basel III, Western regulators are effectively admitting that the Western model of paper alchemy has failed. This is a strategic concession. The West is aligning its banking regulations with the East, acknowledging that in a period of high debt and currency instability, physical metal is the only true safety. This transition levels the playing field for countries like Russia and China, which hold massive physical reserves while placing the debt-heavy Western nations at a significant disadvantage. D. The devaluation of the dollar and the rise of stagflation. The revaluation of gold and silver as Tier 1 assets has a direct negative impact on the US dollar. To purchase the physical metal required for compliance, banks must sell other assets, primarily US dollars and treasuries. This creates downward pressure on the dollar at the same time that gold and silver are being revalued higher. Furthermore, as banks are forced to hold more capital, they will naturally lend less. This will trigger a credit crunch in the general economy, making it harder for businesses and individuals to obtain loans. This deflationary pressure on economic growth, combined with the inflationary pressure of currency devaluation, leads directly to a stagflationary environment. In such a scenario, silver has historically been the top-performing asset class, as it serves both as an industrial necessity and a monetary hedge. E. The exposure of fraud. The coming audits. With the implementation of Basel III, we expect a new wave of stringent audits. Regulators will no longer accept a bank's word that the metal exists. They will require proof of allocation. For years, there have been suspicions that banks were double-counting leased metal, counting the same gold bar on multiple balance sheets. As these audits commence this quarter, any bank that cannot prove physical possession will face severe penalties or closure. This creates a doom loop where banks must buy metal on the open market to cover their shortfalls, driving the price up against their own short positions. The implementation of Basel III Endgame this Monday is the signal that the global financial cycle has turned. The era of infinite leverage and paper manipulation is being replaced by a system of transparency and physical backing. This is a slow, bureaucratic return to a gold standard disguised as banking regulation. The institutions that have managed the global economy for the last half-century are admitting that fiat currencies are failing. They are preparing their lifeboats, and those lifeboats are made of gold and silver. This is a massive transfer of wealth. Those who hold paper assets, including unallocated metal accounts at major banks, are at risk. If you do not hold the physical metal, you are essentially holding a bank's liability at a time when that bank is being forced to deleverage. The mainstream media will likely ignore the technical details of the NSFR and Basel III, focusing instead on market volatility without explaining the root cause. But the root cause is clear. The rules of the game have changed. The system is being forced to be honest for the first time in 40 years. As the banks step back from manipulation due to these new regulatory costs, true price discovery will finally occur. The price of silver must rise to a level where physical supply meets physical demand without the interference of paper dilution. That price is significantly higher than what we see on the screen today. The banks are buying, the nations are buying. The question is, are you aligned with the new rules or are you still betting on the old ones? Follow the money, monitor the regulatory shifts, and prepare for the Basel III era.